Plug Power reported earnings before the market opened on Tuesday, and once again, the results were an absolute disaster. The company continues to burn through cash, but continues to position itself as like it's making some sort of drastic improvements. I want to go through the numbers here. This is a stock that I have warned about on this channel. They have been making promises about growth, about getting to profitability for more than a decade. I've been covering the stock for more than a decade. The story has not changed. It didn't change this quarter. I don't think it's going to change in the future. But prospects for surviving have changed, and that's because the balance sheet is bigger and more risky than it has ever been. So I'm going to dig into all that today. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content, and thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. First of all, let's look at the market's reaction. And you see shares are down about 5% today. But what I want you to focus on is this number right here. The market cap is about $1.7 billion. This is going to be key because if the company is going to survive, it's going to need to raise more money. There's only two ways to do that. You can sell debt or you can issue equity. And the reason I say that, let's start with this earnings report with the balance sheet. So there's only $94 million worth of cash on the balance sheet that Plug Power can use in its operations. $216.8 million is restricted. That is in current assets. There's also restricted cash in long-term assets. So there is a lot of cash on the balance sheet, but it's not just cash that they can use in their typical operations. The other thing that Plug Power has now is about $150 million worth of debt on the balance sheet. There's also finance obligations of $278 million. So there's a lot of money pledged for the future that the company is going to have to actually make a profit to pay for. And that's really the key here, is that when you have debt on the balance sheet, when you have future financial obligations, you have to be making money on the stuff that you're selling. And Plug Power is not doing that. This is the income statement. We can look at every single one of these line items. Sales of equipment, related infrastructure, and other, $107.1 million in sales. What did it cost to generate those sales? $149.9 million. That's terrible. You don't want to be selling equipment, hard goods, for a loss, especially if you're not able to make it up in other things. Services performed on fuel cells and related infrastructure, $14.1 million. The cost of that, $9.1 million, plus provisions for losses related to contracts, another $6 million. So they're losing money on that piece. Power purchase agreements. This one has never made sense to me. $20.5 million in power purchase agreements. What is it costing to generate those power purchase agreement sales? $51.8 million. Losing more than $1.50 for every dollar in sales. The next thing, fuel delivered. $29.8 million. What did it cost to make that fuel? $55.5 million. Add all of this up and you're losing $100 million on your gross cost. At the very least, a company should be able to cover their costs to produce what they're making. If you're selling hydrogen, you need to charge enough for the hydrogen to pay for the production of that hydrogen. If you're selling a fuel cell, you need to be able to charge enough to pay to actually produce the fuel cell. That's the way that business works. Otherwise, you keep burning through cash year after year after year. But that's exactly what Plug Power does. $100 million in losses on a gross basis. On top of that, you have to pay for all of these operating expenses. R&D, selling, general, administrative, which is somehow $92 million per quarter. So look at that, spending very, very little on R&D, spending a ton of money on SG&A. So the operating loss for the quarter, and this is just one quarter, $216.2 million. How in the world do you stay afloat if you're burning that much cash? You're losing that much money on the income statement. Well, let's get to the cash flows. And I actually want to start up here because one of the first things that management highlighted was operating cash flows improved 31% quarter over quarter, reflecting improved margins, working capital efficiency, and leverage of existing inventory. That sounds great, doesn't it? What does a 31% improvement in operating cash flows look like? It looks like burning almost $600 million in cash flows, but that was better than a year ago when they burned $863.9 million in cash. You're starting to see that the story of Plug Power is that they are just burning cash quarter after quarter after quarter. Yes, they're growing the business, but they are growing it by burning through money that they get from investors. Here's that line here. They're losing money on operating activities, but financing activities, a positive $779.2 million because they raised $793.2 million through selling stock. What does that do for investors? It means you own less of the company because a year ago they had 599.5 million shares outstanding. Now they have 858.4 million shares outstanding. So the share count has been increased by almost 50% in just a year. And this is not a new story for Plug Power. When you have a money burning business, the only way to keep it afloat, like I said earlier, is either to sell debt or to issue more shares. And Plug Power has been issuing shares for decades. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. This chart only goes back 10 years, but the same story would be happening if it went back another 10 years. The share count has increased at a 15.8 compound annual growth rate. And actually, that's despite the fact that management has done a really good job selling shares when the stock was extremely expensive. You can see they did that in 2020 and 2021. That was a great time to be selling shares and raising capital. But they've had to go back to the market in the last year. That chart doesn't even include this most recent share increase, which would add another 200 million shares to the number that I showed in that chart. So these are awful trends for Plug Power. And the reality of this business is you could be the biggest bull on hydrogen energy. You could think that fuel cells are going to be the future, that electrolyzers are going to change the way that we use energy. I think all of those things can be true. But it can also be true that Plug Power is a very poorly run business that has never been able to generate a positive profit or positive cash flow. And that's ultimately what you have to have a sustainable business in the market. So the very sober reality is I think this is a uninvestable business because all you're going to get as an investor is get diluted time and time again as management needs more and more money to fund operations and fund the ongoing losses of everything that they do, selling equipment, selling power, selling fuel. Every one of those things should be money makers for Plug Power, but they're not. They're losing money on a gross basis. The cost of goods sold is higher than their revenue for every single one of those items, and that has been consistent over the years for Plug Power. So I don't have any confidence that that's going to change, and neither should you as an investor. So hopefully this is a bit of a warning if you're interested in Plug Power. Hydrogen could be the future of a lot of things, but it doesn't mean that this company is going to be the future. But let me know what you think about Plug Power's quarterly results. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.